Hey guys, welcome back. My name's Aaron. This is Czar Finance, episode 34, Fundamental Analysis, Balance Sheet. This is going to be kind of a quick one for you guys, so it's not too hard to know what a balance sheet is when it comes to fundamental analysis. Alright, so basically what a balance sheet is when it comes to fundamental analysis is basically, it's a basically financial condition of what the company is looking at right now. Okay, so what are they standing, how are they doing, what's the overall look of the company, are they doing well, are they doing not so well? And basically what the balance sheet represents is the amount of assets or products, things that they own that are of worth value, of worth money, of things that they own, versus the amount of liabilities that they have, things that are of an expense to them, what they owe current money to, or electricity bills, things of that nature. So there's assets and liabilities. Now, an asset is always a great thing to have. We're talking about cash, inventories, accounts receivable, things that are coming in, things that are generating money. Whereas liabilities are things that are costing the company money. The manufacturing process, the gas to run the equipment, the electricity to run the stuff. The equipment that is needed that's going down in value because it's being used. It's sort of like your car is a liability because although it might seem to get you to and from places, a car is a liability. It's going to break down. It's going to need constant maintenance. It's going to need new tires. It's going to wear down on the parts and services and things like that. And eventually you're going to have to replace that part, which is basically considered a liability. So that's the difference between the asset and the liability of a company. Now, when you take the assets minus the liabilities and you break it down, you're left with what's called equity, or basically the net assets of what the company has in total. So the higher the spread, or the more net assets the company has in assets, the more valuable the company is becoming. They have a higher, their growth model is very good, basically. So if the company is in the opposite direction and they have a lot more liabilities than they do have assets, that means they owe more money to something else or somebody else from a loan, or they have too much debt. That is a bad sign of a company that might be these guys aren't bringing enough money to income. They're going to go bankrupt, or they're going to eventually start having to sell things off, or go down and downsize and lay off people, etc., to sort of compensate for their liabilities so they can break even or go bust. So that's basically what a balance sheet is. And then a balance sheet really just lays it out. It tells you, what the asset is minus the liabilities, and gives you the equity of the company, or the final net assets of what the total is, bottom line. What are we doing here for year to year, and how we're growing? Are we making money? Are we losing money? So it's a great way to give a quick snapshot of what a company's doing. Overall, are they positive? Are they negative? Are they growing? And you can start to look at the net assets year after year after year, or quarterly statements, to see if they're growing, or if they're spending too much money on so many things just to do research and development. But eventually maybe that research and development will turn out to be really good. So typically when a company comes out and they're brand new, their liabilities are a lot higher because they're just starting out. The things are costing them money to manufacture things, to get the business up and running. It's costing them a lot of money to get going. But in the flip side of that, their gamble is that they're going to start selling a whole bunch of things. The profits are going to start rolling in, and it's going to offset those liabilities and return a better positive net asset for them, and make them a strong company and a loyal brand, etc. So that's really what a balance sheet is, and I hope you understand that. It's really straightforward. Assets minus liabilities, equity brings the net asset. It just shows you altogether what the company's overall status is. Thanks for joining me. My name's Aaron. This is Czar Finance, episode 34, Fundamental Analysis on a Balance Sheet. Talk to you later. Bye.